Pharma. Vivek Paul, Head of Portfolio Research at BlackRock Investment Institute, is with us now to take some questions. Vivek, thank you so much for joining in. Not an easy market at all to be in, right? Because we're just living in greater and greater uncertainty. As one commentator, I think, said that this is maybe only the beginning of uncertainty. But what do you make of the whole global stock market rout? When can there be some hope of perhaps stability?
It indeed is a very uncertain time, and you're right, and thank you for having me on. So I think the thing I would say relative to the framing you had is maybe we're approaching peak uncertainty. And I think that would be an important point to make here. Yes, there's been a lot of, day-to-day things have been shifting and changing, but I think over the course of the coming months, we would start to see some of that smoke clearing, I guess, in terms of the fog that is out there at this moment in time. By all means, I think this could get worse before it gets better. We should be very aware of the fact that there are some material changes happening to the global markets right now and a wide range of possible outcomes. But we still have a view that when you're looking at a little bit further, about 6 to 12 months from here, we'll be past that peak uncertainty and we'll start to see an environment whereby the US assets, for instance, can start to outperform again. But absolutely right now, huge uncertainty, and we could get worse before it gets better, because what we've seen in the last couple of days is a stagflationary shock.
Vivek, you said that perhaps in some time from now, US risk assets could start performing well again. Can you just expand on that? Because what's happened is obviously the US equity market's back is broken. It's taking down all global equity markets along with it, and there's a general sense of risk off. So what do you see ahead? When do you see some semblance of stability returning to that market? Because, I mean, we don't know when this is over. We don't know the new trade alignments, the final tariff lines, tariff rates. Nothing is clear right now.
It's very true, and indeed the US has underperformed other regional stock markets year to date for the reasons you've mentioned, because of the huge uncertainty that is there. I guess one of the things that I'd say though is that markets had been anticipating looking at the measures in the last couple of days as a sort of a milestone with regards to how we look at the future kind of opportunity set. And my point is that what we've seen announced are presented at least as ceilings. They're presented at least as an upper bound of how severe, I guess, some of the imposed tariffs could be. And there's room for those to effectively come down. There's room for the landing zone to be less than the ceilings that are currently put out there. And my anticipation here would be that as we get through the next couple of months, some of the uncertainty that has, as you say, rightly been plaguing the stock markets is likely to be behind us. It's not to say that everything is entirely clear, but we've got to remember that US assets have underperformed year to date, and despite the fact that actually the underlying fundamentals for some of those assets hasn't materially changed, right? The overall sort of US consumer remains comparatively strong. We still have some of the best tech companies in the world in the United States and trading now at cheaper multiples than they were just a short period of time ago. So again, just to be clear, by no means am I saying that there is not room for this to get a little bit worse in the near run, but once we start looking a little bit further ahead, the point I'm making is that that's when we should be behind the peak uncertainty.
Couple of months, that's what Vivek is saying, that this peak uncertainty phase also could last maybe a couple of months.
The thing is, I don't maybe we'll get Vivek's thoughts as well. The reason markets sold off in this unhinged way last night is because the tariffs were unhinged. It goes back to that how the tariffs were calculated. If they were reciprocal, markets were prepared, but they were not reciprocal. They were, in a way, out of thin air, 52%.
Yeah.
The problem is it was calculated basis, say India's surplus
Trade
against US is $40 billion. US is saying wipe that $40 billion clean. That's never going to happen. So there is no way out. That is the problem, right? I mean, if there is a way out to solve, you can negotiate, but what is the negotiation? What are you negotiating on? Because you're saying we don't want this deficit, but there's no way to do that. It's not going to happen. Not just with us, with anyone else. So I think actually
negotiating down. I take your point. I mean, negotiating down tariff barriers is one thing. You can argue that there should be no tariff or non-tariff barriers. But wiping out trade deficits is a separate matter.
Which is what they're saying. So actually, theoretically, we may be one headline away from market stability. Theoretically. I mean, they may come and say, well, this is I don't know what they can say. But the point is that is essentially the issue. That how do you, there's no path forward to negotiating out of this in the way this has been calculated is arbitrary. Vivek, would you agree with that?
I think one thing that's very true, and I sympathize with the points you're making, is that up until now, markets have been guessing as to what the true underlying goals of this are. And I think, as you've mentioned, there have been different things that have been put forward. The point I'd make, though, is that there is room for that negotiation. I don't anticipate the negotiation to end at the status quo we had prior to the election of this administration. I think it's clear that the floor now is the 10% sort of effective tariff rate that we're talking about, the global tariff rate that we've been talking about. So it is a different, it's a different environment that we're in relative to the past. But the point I'm making is that the markets are reacting as if, to some degree, the ceilings that have been announced are likely to be the landing zone, and that's the direction of travel of the risk sentiment. The point I'd make is that certainly with a country like India and its relationship with the United States, I think there is room for the landing zone to be a little bit different to what the current announced tariff is, and I think that's the point I would make when it comes to the
Vivek, I think that point is taken. So India's weighted average is about 9.4%, right? Let's get specific. So you say, okay, we're going to cut it down to 2%. Does that bring down our claim tariffs of 52% down to the 26% down in the same 26, which is the effective, the so-called discounted tariff? Will it help bring that down to 10%? Well, can we be sure?
I think...
And that's the problem. How do you... Yeah, sorry, go on.
Sorry, Prashant. Sorry, I didn't mean to interrupt you. I think the point I'd make here is, though, that this is that there are, exactly for the reasons you mentioned at the outset, there are multiple dynamics here in terms of what the US is trying to achieve. And the point I would make is, for instance, rather than enacting higher tariffs on India, it could be that if India sort of responds with lower tariffs on United States imports, then effectively the landing zone looks a little bit different. So the point would be that because of some element of ambiguity around the motivation for some of this stuff, I think there is this room for the landing zone to be different to where we currently are.
Okay, Vivek, we leave the conversation here for now. Thank you very much for joining in with your thoughts and insights.